The single most frustrating thing about the mortgage industry is that the rules are always changing. And when I say rules, I'm actually referring to two separate things. The first is what we call the guidelines. And the guidelines are simply the requirements that must be met in order for you to get approved for that loan. So an example of a guideline would be that you have to put a minimum of 3% down in order to get a conventional loan. The second thing I'm referring to when I say that the rules are always changing are something called loan level price adjustments, or LLPAs. Now you might know these more as fees that are passed on to you for your specific conventional mortgage. It's really just a fancy way of saying that your interest rate is going to be adjusted because these fees are often baked in or added to the interest rate. So if you're thinking about getting a mortgage now or in the near future, you need to understand why your interest rate is being adjusted and by how much. Now, if you've been following me for a while, you might be saying to yourself, didn't you already make a detailed video on this? And yes, I did. And if you watch that video all the way through, first off, thank you. But that's really more of a lecture than it was a video. But as I had mentioned, the rules are always changing. So some of the information in that video is no longer relevant today. So what I plan to do with this video is to not only bring you up to speed on what's changed, I'm going to also show you how it impacts your interest rate now. And I'm finally going to wrap this all up and show you why you can't simply compare your interest rate specific to your buying scenario to a quoted interest rate that you see online. So what changed? The biggest change, and the one that will most likely impact you, is going to be the change in credit score tiers. If you remember from that video, 740 was the highest credit score, meaning that if you had a credit score of 740 or higher, you would have the best interest rate. Or a better way of saying that is you would have no negative impact to your interest rate based on credit score. Well, now 740 is no longer the highest credit score tier. In fact, there's actually two tiers above that. So these new tiers are 740 to 759, 760 to 779, and 780 and above. And I'll show you the specific matrix a little bit later in this video, but what you need to know is that 780 or higher is now the best credit score you could have for your interest rate. The other big change is in the massive difference in pricing for smaller loan amounts versus larger loan amounts. Now, traditionally, a larger loan amount was much more desirable to an end investor. But for the last year and a half, this has been the complete opposite, and I'll tell you why. Up until the last month, rates have been on an upward trajectory. But what goes up must always come down, and the end investors know this. So if you think about this from a very practical standpoint, the loan amounts that are larger are going to be the first ones that get refinanced when rates come down. And this is also important because money is made on the servicing of these loans. So if a loan has a smaller chance of being held for a longer duration of time, meaning that less servicing is going to be able to be made on that loan, the cost needs to be passed on to the consumer up front. So how exactly is your interest rate impacted? I'm going to put the actual matrix on the screen, but I want to give you fair warning. It can feel a little bit overwhelming. So let me walk you through it. The left-hand column is the credit score tiers. So if you remember, I had mentioned earlier that 740 is no longer the highest credit score tier. And you can see this in this column, the 740 to 759 tier, and then the two tiers above it with 780 being the highest. Now the top row is what we call loan to value, or LTV. And a really easy way of thinking about this is if you take 100 and you subtract the percentage that you see there, that's the down payment amount that somebody is putting down. So where you see 97%, that just means somebody's putting a 3% down payment. So the matrix is color coded, meaning that anything in red or a color close to red is going to have the most significant negative impact in fees, which is passed on to you via your interest rate. So remember, 740 or higher, there used to be no negative impact to your rate. Now, that's the danger zone, anywhere from 5% to 25% down. Now, there's no matrix for adjustments based upon loan amount, so this is where having somebody who does this day in and day out and is in the trenches is extremely valuable. You can also ask any other lender and they'll tell you the same thing. Now I'm also going to use this opportunity to shamelessly plug my weekly interest rate update that I can subscribe you to if you send me your email. Now, back to the loan amount differences. Now, every week in this rate update, I price 3 loan scenarios using these criteria right here. And the only difference that I change is that I change the loan amount. So I price a $150,000 loan, a $375,000 loan, and a $562,500 loan. Again, all other loan characteristics are the exact same. And as you can see here, there's a massive difference in pricing. So the low end is actually for that $150,000 loan amount, and the high end here is for that $375,000 and $562,500 loan amount. So now that you've seen how big of an impact credit score and loan amount can have on your interest rate, it's time to take this one step further and talk about why you simply can't compare your rate that is specific to your credit score, your loan amount, your buying profile to a rate that you see online. So as I've been mentioning throughout this whole video, your interest rate is going to be impacted by your credit score as well as your loan amount. Now there's a whole bunch of other factors that also come into play, but for the sake of time, I'm just going to revert you back to the original video, which that information is still correct. However, I do want to highlight 3 other characteristics or specifics of a loan that are going to have an impact on your rate that you need to be familiar with. The first is property type. So if you're planning on buying a condo or a townhome that is legally a condo, you're going to have a negative impact to your interest rate as opposed to you buying a single family home. And this all just simply comes down to risk. The investor who's giving you that money views you putting that money into a condominium where there's other individuals in the building who could default on their loans. There's other things that could be required, such as additional maintenance on the building. They're gonna build that cost into your interest rate. Now, the second is the amount of income that you make. So if you make over 100% of the area median income in the city in which you're gonna purchase, you're gonna have a worse rate, or you're gonna have a negative impact to your interest rate than somebody who makes under 100% of the area median income. The last is gonna be the amount of time that you need to lock your interest rate for. So the longer lock periods, such as a 60-day lock or a 75-day lock, are gonna have an interest rate adjustment than somebody who only needs to lock for 30 days. Thanks for being here. If you enjoyed the content, please like, subscribe, and share the channel, and we'll see you back here on the next one.